holding pattern, no real great movement in the last couple of hours now, but holding above the 24,800 level. Siddharth Vora is with us. He's head of quant investment strategy and fund manager at PL Asset Management. Siddharth, good to have you with us here. Thanks very much for your time. Prashant this side. Now, take us through what you're doing. Where are you finding the quant ideas to go long and to make money? I mean, where are you finding momentum really? Because it's, if you just pull back and look at it on a day-to-day basis, you just get the feeling that, stuff which is up sharply, 2-3 days, sharp reversals, 2-3 days later, then something else starts to move. It's a very broad rally, absolutely no taking away from it. But to get behind and stay long, do you find it challenging? Go on.
So, hi Prashant. Firstly, thank you for having me on the show. And I'll just take you guys through what we're really doing and what we are reading based on our quant indicators and models. So the first takeaway is that we believe that the strategy must now change from return maximization to risk minimization. That's a very clear signal that we're getting from all our models. When I look at things like volatility measures, we know that volatility has come off quite sharply in the markets. But at the same time, the risk appetite has also come off. And if I look at style orientations now, it's a very clear comeback of the quality low vol style of investing. And we believe that the best cycle for the whole value and momentum approach, which worked in the past 3 to 4 years, that is nearing its end. We also see that polarization, which was not existent in the market for the last 3-4 years, is now likely to make a comeback. So the whole broad-based rally, the whole democratization of returns, which we saw in the last 3-4 years, our signals capture that there is a mean reversion within the theme of polarization. And when I look at it from a valuation perspective, large caps still continue to be relatively cheaper than the mid and small cap packs within India. And having said that, we have completely taken a very, very defensive stance. So I think 75% of my portfolio now is allocated to sectors such as consumer staples, healthcare, consumer discretionary, and IT. So within this whole fabric of the market where we're seeing risk appetite go down, momentum and breadth coming off, we are taking a shelter within the defensive sectors, the non-cyclical sectors, so to say, as the focus of the strategy is no more capturing the highest upside return. It's capturing alpha by minimizing risk rather than by capturing upside returns. So there has been a lot of change over the last couple of months that we've made in our portfolio as well.
Siddharth, that's very well explained, but what are the parameters that you track which suggest that the strategy now needs to shift to minimizing risk? In your internal model, the quant model that you track, what are the parameters that you track?
So we track a lot of market risk indicators. We track a lot of market breadth indicators. We track macro risk, which as even currently the macro risk models are quite sober. We don't have any major red flags on the macro side of it. But when I look at valuation indicators, breadth indicators, sentiment indicators, volatility indicators, all of them are close to their multi-decade, multi-cycle highs. And usually when these indicators trade at such extreme zones, we see sort of mean reversion play out in the next 3 to 6 months. Just to give you an example, right? Industrials or PSU for that matter, these sectors are trading at the 95th percentile of their long-term averages, which means we should expect some sort of mean reversion in terms of returns in these sectors. So as the risk reward opportunities start getting narrower in sectors or in style baskets like value or momentum, we automatically gravitate towards those sectors and those styles where the risk reward is still more favorable.
Okay, so you're going to low volatility as one part of it, basically getting back to defensives. So Siddharth, you made a point on the way this whole polarization theme is playing out. Can you elaborate on that? What exactly do you mean?
So for the last 4 years, if you look at data, it will tell you that the top 10 stocks in India have the lowest concentration in the total market cap of India. That's not because they have underperformed, which they have, but it's not just because of that. It's because the rest of the market has done so well. Now, this particular indicator is seeing a comeback, which means it's a combination of the top 10 doing better and the rest of the market sobering down. So that's just one example. Like that, we have 10, 12 different polarization and market breadth indicators. Another simple example is Nifty 500 equal weight to Nifty 500 market cap weighted index. We track the ratio of these two indices. Again, this is showing that the last 3 years have been very broad-based markets. And now this is going back towards the market cap weighted index doing better, which means we're going back to a scenario of some sort of polarization in returns. And I'm not talking about profit or revenue polarization. I'm simply talking from a risk return perspective.
Oh, got that. You mentioned that in your portfolios, you're going back to defensives. You said IT, consumer staples. Didn't hear you mention financials anywhere. That's where, I mean, it's still very confusing for investors because on the polarization parameter, the first thought to my mind was, HDFC Bank. Is it a return of the likes of HDFC Bank? But what's your overall stance on large financials?
So the way we look at financials, it's not just banks. For us, we've actually made bulk of our returns from the financial sector without owning even one private bank. Currently, there's roughly a 14% allocation to the financial sector, but we have different names. We're mainly exposed to the capital markets theme rather than the banking theme. And even if you track the fundamental cues, it's very clear, right, that deposits are not growing fast. The credit deposit ratios are turning adverse. And the sector is still plagued with lack of growth visibility. And as opposed to that, within the financial sector, annuity-based businesses like wealth managers, asset managers, they are doing much better. They have much higher visibility. And if you look at them on a PEG basis or a growth-adjusted basis, their valuations are still not ridiculous. So in a time like this, I would classify banks still as a cyclical sector and capital marketplace still as a higher annuity sector. So given this dichotomy of earnings that is visible for the next 3 years, we still are more comfortable owning the capital marketplace within our financial exposure and completely staying out of the private banks, so to say, which, as you're mentioning, has a lot of value and a lot of mean reversion possibilities going ahead, but nothing in our model so far.
Siddharth, quick answer here. Since when has your model been flashing red? Because so far a correction has not been forthcoming. And you said that typically in 3 to 6 months, you do see a mean reversion or a correction in this case should happen. So since when has your model been giving you these signs?
So what we've done, so last 12 months, the first 12 months of the portfolio, we were a value momentum fund where we were running a 25 to 30 stock portfolio. 2 months back, my models started giving red flags that, okay, we need to change the regime. The style regime is changing. The risk regime is changing. We're going out of risk on and moving into risk transition. We've not gone into risk off yet. So we're going into a risk transition zone. So in this risk transition zone, my portfolio allocated 50% of its weight to a quality low vol theme and another 50% to a value momentum theme. Usually we run a 25 stock portfolio. Given that there was a risk transition and a regime conflict, we diversified to 50 stocks to manage risk. And now that there is more clarity that we are in fact in a quality low vol regime, we've gone completely in a 30 stock portfolio in a quality low vol regime rather than dividing between two. So it's been 2 months since my models have been flashing red. And now, of course, it's very clear that we're moving into a quality low vol sort of strategy.
So do you want to tell us sort of 5 names which fit the criteria?
See, as a quant fund, you're never that bottoms up. You're always top down. You're trying to get your sectors right. You're trying to get your style orientation right. You're trying to get your asset allocation right. You're trying to get your large, mid, small mix right. And you're trying to get your beta right. And whichever stocks fit within these criteria automatically come in. And as of now, we're actually in the process of rebalancing the portfolio. and hence I really cannot disclose any stocks that we're likely to purchase as we go along in the next 4 or 5 days.
Okay, all right, next time then. Sid, thank you very much for joining us. Good speaking with you. Appreciate you joining us here this afternoon. Well, 45 on the Nifty. We've got, what, 24,800 plus on the...
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.